again, this is Al. This is Al Puchala. I'm CEO of CapZone Impact Investments in Connecticut, and I'm also proud to be on GRI's advisory board. What I'd like to do today is really give a high-level discussion of zones, but really not to stop there, but to really understand how we can help the state of Maine attract those dollars and be good partners and citizens for those locales. So we're going to spend a little bit of time just up front, level setting, understanding opportunity zones, but really more importantly, tying to how those flows of capital that we expect can find a good partnership with stakeholders on the ground in Maine. That's the goal today. We'll have a Q&A and other types of discussions to make sure that we're really suiting your needs. So maybe if we can go to the next slide. Great. What are opportunity zones? So opportunity zones, think of them basically as census tracts. What's nice about the program, it brought everyone together in terms of how those census tracts were picked a few years ago. So the federal government gave the right to the state governments with the input of the local governments to pick those zones. And those zones, it's about 1/8 of the size of all the footprint in America in every state. They are now in place until the year 2047. So without getting into the details, they're throughout America. They're in urban and rural areas. They have the buy-in from the state and the local partners on how they were picked. There is some discussion potentially to extend the program to more zones and longer, but suffice it to say, this is a new way to approach public-private partnerships. It's bringing investors together to find partnerships with local stakeholders, the public authorities, the private developers, the community investors, and citizens. So a new way to look at this thing. They are long-term, they're holistic, and I'm happy to say Maine has its share of zones, and we'll be talking about those later today. Next slide, please. Great. Before we go further, there are a few things I'd like to point out that are in play as we speak. Number one, a lot of money has already been put in funds around the country that are controlled by investors who are now looking for investments. As of a couple months ago, $15 billion has already been identified that have gone from investors with money to funds that have to now invest in opportunity zones. So it's not a waste of time and effort to see how much of that money can find its way into Maine. And the estimates are that number will rise by many magnitudes over the next few years. Investments can be made until the year 2026. So that 15 billion should double, triple, quadruple, or more. So it's worth paying attention and seeing if some of that investment dollars can be directed to Maine. The COVID impact now is that money can be tied with other sources of capital to create a capital solution. Those could be federal programs, like Steve talked about. The Department of Transportation is saying if it's a zone investment, you actually get a priority to get a grant now from the federal government. Same thing from corporations. They want to find zone deals for ESG social impact. So think of the program being very narrow itself. It's a tax break for investors, and hopefully that's shared with the community, that benefit. But it also now is part of a capital structure that can both be tied to flows of dollars that are be coming out of Washington to deal with the COVID impact. And there's a lot more legislation pending to make the program more connecting with local initiatives, and also having more transparency and reporting, which is a good thing for the program. We should know what happens with those dollars since we're all citizens. Next slide, please. I'll keep going back to Steve's mantra. This can be very confusing. So we're not going to get into the details, but basically think of this slide as from the investor's point of view. So, this is a lot of making sure that the investor understands why they're participating, why the local community is participating, why lawyers or accountants can help create the structures to make it work. But this is an investor-facing slide, but we wanted to share the perspectives with you so you understood what benefit the investor is getting. The investor gets 3 benefits. The investor, when they get a gain on something unrelated to your project in Maine, gets to defer tax payable on that gain. It could be a stock, a bond, a company, any asset where they would pay tax, they get to not pay for up to 6 years now. That's a big benefit to investors. So that is one benefit. When you sit down with an investor, you understand they are not paying their tax because they are investing in your project. Number 2, they will pay a little less tax if they stay in the project for at least 5 years. And right now that's 10%. Very technical, it could be a higher level to 15%. So not only do they get to delay paying tax, which is a time value of money, that's a benefit, on their old gain, they get to pay a little bit less, 10 or 15% off. That's before they even give you their investment dollars. So the investor is getting a very good deal. But here's the real key. It's the third box. It's the permanent exclusion. By taking the dollar of gain, paying later their tax on that, paying a little bit less on that, investing the dollar in Maine, the new gain created, let's say the dollar becomes worth $3 over time, the new $2 is untaxed. That is a very, very significant benefit to investors. So when you sit down with an investor, you understand what their incentives are, which is they want a good project, they want to be welcomed into the community, but they're getting a lot of benefits from the IRS. They're getting benefits on their old gain, and they're getting a benefit by investing with you on the new gain. So that just level sets why this is getting so much attention from investors around the country and actually around the world who want to come to America. Next slide, please.
And the key, although, right, is it's compelling those investors to be long-term investors in the community, right? Because they have to hold it for at least 10 years in order for them to get that capital gains relief.
That's right. That's a very good point, Steve. So the idea is a lot of investors often are in and out of stocks fast or hedge funds you've been reading about. That's not the intent here. This is to have long-term capital that the community can count on as being there to support growth and jobs. So the permanent exclusion, the third box, is only available for investors who invest at least for 10 years, and they can actually, as we know, stay in the investment for 27 years. So it's a very large benefit, but only for the long-term investor. That's the kind of investor that you want. Someone who's already getting a benefit, so maybe they can share part of that return with you. And number 2, they're there for the long term to get you through the bumps. And that's why this is such a good fit with resilience and why we're so excited to work with GRI, because these investors are saying, if I could get out of a deal in a year or 2, maybe I don't care so much about long-term resilience. If I'm in for a decade or 2, I better make sure it passes the test of time. I want to have GRI, bless this thing. So it's a really good fit for GRI and CapZone because we believe in long-term investing for the community. But without GRI's imprimatur, the investors may really not feel that that investment is protected over the long term without being resilient. So very, very good program. Next slide, please. So what is a fund? This is I spend a lot of time with folks on this. We're not going to get into the details on the left. A lot of forms have to be filed and percentage tests. And again, I'm happy during Q&A to go through that. I'm a tax geek, self-proclaimed tax geek. So I love this stuff. Many people don't. But suffice it to say, the fund that gets set up, there are 3 levels of, if you will, parties in the incentive. There's the investor at the top who has the gain. He or she invests in the fund. That nomenclature is very important. The Qualified Opportunity Fund, QOF. The IRS mandates that happens. So anytime you talk to an investor, they have to set up a fund. That QOF has certain responsibilities and obligations, and then that fund invests in your project on the ground in Maine. Those are the 3 levels, and we'll talk about all those 3. But what's very nice about this program is that the IRS allows huge flexibility on how you can set it up. So on the right, you'll see at least 3 different types of funds that we see around the country being set up. First is I'm just my own investor. I really don't want to be in a fund with other investors. I don't want to have to know what their incentives are. I want to set up my own fund. That's okay. So the single investor funds can be set up by an individual, by a corporation, by an insurance company. So if you're talking to investors, you may want to ask them, do you have your own fund already? Will you be a single investor fund that does one or more projects or not? That's one flavor that a lot of people have tried just to get used to the program. The second flavor is, I think, very applicable to many folks on this call, is the local fund. So this is the perspective of a city, a state, a region, a rural county, a neighborhood, saying, we want to set up a fund for this geography, and we will welcome many investors for our local fund. So that fund is not necessarily investor facing, it's really the stakeholder focused. So you could say, I'm in a city, we want a city priority of what that investment dollar will go into. We're going to set up a local fund for the city or for the state. And those are happening around the country too. And that works within the law. And then lastly on my list, but there are other flavors, is a private equity style where an investor backs a manager, or many investors do. That manager, can go out and find deals and manage those as a fund. And that's happening too, less so because it takes a lot of work to set that up anyway. And the rules really, for technical reasons, are not necessarily perfect for that. But there are going to be now funds set up that are either national or regional that are really much more kind of Wall Street based, and they'll have capital that you probably want to talk to, but that's only one type of fund. So don't think that it is only a Carlyle or a Blackstone or a Starwood or a KKR. Those types of large funds with great franchises may be active, but you can set up your own fund for one investor, for a club of investors, for your region. They all are fined by the IRS, and we can help figure out how stakeholders in Maine can tap or create those types of funds. Next slide, please. We're not going to go into a lot of detail here. These are the rules that any fund manager, so if you set up your own fund, these are the rules that you have to follow. Am I in good property? And we'll talk about what that is in a second. Is the business really in the zone? Does it work for stuff outside of real estate? Yes. But there are about 544 pages of tax regulations that we're not going to go through, thankfully now, but that allow in the end the investor to say, in the end, this is the goal, that yes, IRS, I have a new gain I've created, and no, I'm not paying tax because I followed all the rules. And these are the rules you have to follow. And a lot of the folks that CapZone works with is help organize these rules of what percentage tests of your assets or your lease or how you pay people or who's related or unrelated. What the IRS always wanted to make sure is the money is going into the low-income communities, and there were no tricks of, well, you have one worker in the zone, everyone else is out of zone, and somehow you're still taking the tax liability, tax obligation, and I'm sorry, the tax benefit. What these rules ensure, if you follow them, is the money really went into the zone, and they can do things outside of real estate. Infrastructure works, operating companies work. The IRS was very generous in giving its guidance to say, we want all types of investments to get the incentive as long as they're really being invested in the communities that need the capital. And initially people focused on real estate because you could see the asset, it was in the zone. You knew the users of the capital, the tenants, were in the zone in the building, but the law says investment, it doesn't say real estate. So what CapZone is doing with GRI right now is making sure that the incentive also can tie to infrastructure, to the bridges, to the schools, to the courthouses, to the data centers, childcare facilities. Those are all not only appropriate, but those are the goals really for what the incentive was meant to do, to bring supportive investments to that community that can be shared broadly. So again, this is a new law, it's being rolled out, but it works as long as you follow these rules on is it good property in the zone that you can get the incentive. So we're very proud to make sure that now we're looking at different types of investments like social infrastructure, like digital and water and renewable power. Those are all very, very good candidates for the zone incentive. Next slide, please. This just summarizes what we spoke to. Again, infrastructure, as we all know, is going to be a high priority for the new administration and for many on a bipartisan basis around the country that want to rebuild America. It applies to all these sectors: social infrastructure, transportation infrastructure, digital, water, solar, wind, and tourism is a big focus because the infrastructure to support the tourist industry is very, very critical. So we'll talk a little bit about that later. And Maine could be a very, very good candidate for helping rebuild its tourism infrastructure using the zone incentive tied to other federal grants and loans. Next slide, please.
So Al, as an example, if you might here, if we're looking at a traditional loan, like say that the Economic Development Administration might provide, where they'll say, if it's in a almost maybe a 50-50 split, they'll put 50% down. The community or the state is supposed to provide the other 50%. We know if it's in a federally declared disaster area, that ratio can move to 80-20. So now it's 20%. How does that become a P3? How would the private play in to help meet the match requirement under that kind of scenario?
Was that for me, Steve? I just came in for a second.
Yeah.
That question for me?
Yeah, that question was to you. So how would the private player potentially help support a match requirement instead of the community or the state having to find the resources to meet that match?
Sure, that's a very good question. So think of the incentive for the opportunity zones as a very linear incentive. In the end, there's only one really major goal, is to make sure the IRS rules are complied with, that the investment was made in a timely manner and in a manner that really was invested in the zone. Any other capital around that investment is fine. And the IRS is very clear about it. So if you want a bank loan and it goes into the project, that's great. It didn't queer the incentive. If you get a federal grant, if you get a local accommodation of a tax abatement, those are all fine. So what I would say is, by creating a zone investment, and any $1 that comes in from the zone investor, it now becomes a zone investment that gets a priority from the other incentives, from federal grants, federal loans, even with EPA now, some help on dealing with brownfields. So the value of a zone investment is amplified because all those other types of capital flows can attach to the zone investment and frankly enhance the returns on the investment, but also help bring in more capital to that region. So it works very, very well, and it was meant to do that. Great. So what's the opportunity for Maine? The key is this incentive is different from any other program that I've ever seen in my career, over 40 years in finance, because the money actually gets raised first and has to find a project. Normally projects are spent through development periods, and then they go out to try to find money. So what you really want are projects that will get the support of the community, that have to happen now, because the investment has to go to work now. These QOFs, these funds, if they don't invest, they get penalized within 6 to 12 months. So the money's there now. It's looking for projects. It can work outside of real estate. And if Maine can put up on basically the platform of a supportive set of projects, there will be funding that at least will look very hard, and I would hope would close to invest in Maine. So it's an immediate opportunity. It's large. It's different. So it's going to take a little bit of work to make sure all parties understand what's happening, but it's something that could be very positive for the state. Next slide. To get just a little bit more detail on what I just said, is if the state said, look, we have one or more projects where the customer's identified, the off-taker for the infrastructure project, solar or digital, has been identified, we have the support of the community that we're being welcomed in. We're not coming in and gentrifying or pushing out, historical stakeholders that should be part of the solution. That's very attractive for investors, because then you're stepping into an investment that is very clear. There still could be many risks of pricing or what happens in the future, but a lot of the risks that you can take off the table, which is who's going to use it and is it ready now, is very important. And on the other hand, the project really can get approved, not to get anything it shouldn't get, but to get what it should get fast. This is all speed to market. The money has to move quickly to find the zone, or else it doesn't get the incentive. And frankly, I would guess that Maine and other zones around the country need the money now. They don't need it years from now. So the very good opportunity is to match good projects with investors who are ready to go. And sometimes that means that everyone works together to get through that approval process. And that will be the permitting and the approvals. Just, again, not to do anything that shouldn't happen. Everything that should happen, but to do it quickly so that money can be invested to help generate economic activity in Maine. Thank you. Next slide. Maybe, Steve, could I hand off to your team, who's done so much great work in Maine over the last few months, to talk about how the general overview I just gave can be germane to what's happening in the state.
Absolutely. Robin, you want to take it from here? Robin, you're on mute.
There we go. So we included this slide just to sort of jump from where Al just left off, that there are more funds and dollars sitting there than there are fundable projects. And Maine has 32 opportunity zones, which we've identified here. We're looking at the three: Madison, Saco, and Katahdin at Millinocket, East Millinocket. But the point is, from a state perspective, there's a lot here that could be attractive to investors. And investors, as I understand it, not to put words in Al's mouth, but to try to say what I've heard him say otherwise, investors like to join a party. They like to see where other people are active. They are attracted by things where it's more than just one-offs. And so part, again, of what we're doing from the GRI perspective is helping, as we look at each of the three communities we're focused on, to help think about, or help the state think about what are ways that this can be applied across the state. So this is just a reminder that while there are three communities that we're working on here, we believe that there are things about working together with other communities in Maine. There may be opportunities as the state is looking at this from a broader level to think about how these zones can be used to meet needs across the state. So that's the point of talking about the Maine opportunity zones.
Maybe an example here might be, an investor outside of Maine who's very interested in childcare facilities, and there's one of the communities that we have, says, boy, we'd like to, have an additional childcare facility. But the size of that project as a single project may not be all that attractive. But if the state is able to identify that across 32 zones, there are 32 child care centers, or, some subset of that, 15, let's say, that could bring a much higher level of interest from that outside investor to say, let's start with this first one, but now I can see there's a path forward where this could grow and be a significant investment. Because it can be of a scale that is of interest to them, given the amount of resources, capital they're trying to put to work.
Right.
Steve, could I just make one point? That was a very important point. From the investor's point of view, significant money has to go to work to make it, to learn about this new asset class. So you can do that in one and two ways. You can do a big project and put a lot of money to work and get the incentive, or you can do many small projects, but they need to be similar, right? What's nice about the zone program is you get the same tax regime across all the zones. So if you can set up, whether it's, childcare centers or a 5G rollout or data centers or solar, a dozen, 2 dozen, 3 dozen of the same, not only do you get that money out, but it's diversified now, which is better for the investor. So having a program across the state is a very attractive approach for investors.
Right. Okay. And Larissa, I'll flip this to you for you to talk about the examples here in the state of Maine.
Sure, thank you, Robin. These are just short examples of 3 towns or communities that are working either separately or together to develop their own funds, or working with a capital management or investment firm that is managing a fund to improve their or attract investments to their projects. One of them is Augusta. They had a building that was redeveloped, and it's being redeveloped with opportunity zone funding. And Lincoln, Calais, and Belleville were towns that created a mega fund that is organized by the towns and managed by Acadia. And they created this fund to work together in trying to attract investments, to improve their downtowns, attract new businesses, to attract new people to these towns and improve their economic development. I think that's it.
But the point is that, these are 3 examples. Al and his team have examples from all over the country. The idea, though, is that there are things already happening in Maine along the lines of what, we're seeing as good practices, effective practices across the country, and also things that we think could be of interest as we think about the 3 communities that we're focused on here, looking at how the community could establish its own fund to help steer or attract the kinds of investment that it wants for the community. Communities working together to build a mega fund together because like in Steve's example, we need more childcare or more small business downtown, and helping to maybe accomplish that across several areas. So the idea was to just give you some local examples that might help spur your thinking about the art of the possible in the communities where you're coming from.
Definitely. Thank you, Robin.
Next slide. So Al, this was back to you.
Robin, I'm sorry. Before we leave where we were, can I interrupt for just a second?
Oh, please, yes.
So in addition to those 3 funds that are set up, another national impact fund established a $50 million commitment called Arcturus Impact Fund to the state of Maine, in which the Finance Authority of Maine is supporting that by providing credit enhancement up to 20% of that fund. So that's another example of a source that would be available to the 3 communities that we're talking about right now. And that was set up about 1.5 years ago.
Yeah, that's a great example, Carlos. Thanks for adding that in. And again, one that's a benefit to multiple places in the state. So Al, back to you.
Sure. So just to really get very focused and granular, what can we do to take advantage of this unique moment, right? Funds have been set up, new asset class being created, federal government supporting it. I would say very clearly identify the projects, because the projects, it all drives to, okay, what am I investing in? Who's going to use that facility or that business that I create? So is there land available for it? Are there other assets that can be contributed? Is the zoning at third base? So there's only a little bit to do to allow that type of facility. Are there local sources of capital? If you're a national investor, you don't really want to be the only investor in the project. You want some smart money on the ground. So doesn't have to be always a lot of money, but are there some very credible local investors who'd like to be paired up and coupled with a national investor? That's a very, very good way to think about that. And then, are there other advisors? Remember, these are funds. These are complicated vehicles to set up and manage over a decade or two. So you'll need lawyers, accountants, bankers, and others. So can you get that whole advisory network activated to be thinking about it, to maybe modify it in a way that works better for Maine? So these are all the types of things you can do right now: identification of sources, figuring out where things are in approval processes. And remember, time is of the essence. Getting other folks involved who can be important to support that platform. Those are all real-time goals, I think, and that's what's happening around the country in other locales. This is a very state-driven program. The federal government did what it needed to do, passed the law, with the IRS supporting it with guidance, but they're kind of now in the back seat. They passed the law, and now they want really the states and cities and local, regional and rural areas to drive the bus. So the state level is really kind of the natural resting place to have leadership. So you'll see in Connecticut and New Jersey, if you go on their websites, the governor's office, the governor's office picked the zones and now help, modify whatever maybe local incentives can be added on, and also market the zones to national sources of capital. So if you want to see some examples of what's happened in other states, we think Connecticut, New Jersey, but many others are doing a great job. And Maine can be right there also, and is. With the work you've done, I've seen is very, very impressive. So we talked about other examples, but we'd probably be very happy to highlight you to as an example really of a state that is getting organized in a very good fashion.
So it may share just as a very early days, though, example in terms of what is happening in Connecticut. There are 25 institutions of higher education, colleges, universities, community colleges, who are located in an opportunity zone. And the dialogue has begun with potentially companies who want to relocate into the state of Connecticut, potentially locating as operating businesses in a zone next to a university that's going to help provide the workforce skill sets they need for that industry, for that company to prosper. So there's a concern with some of these relocating companies. Will there be the skills there? If I come, the idea is if we can forge a partnership between the college, that company, and because of the incentives of the zones, with the state playing a coordinative role. Again, this is all early days, as like any of these are, but it's just to provide the kind of example of how this works. And again, very unusually, I think, Al can speak to this here, but certainly my experience as well. Virtually every other federal program, there's a belly button to go to somewhere in the federal government to say, what am I supposed to do with this? If it's a Department of Transportation program, or if it's a Department of Energy program, or a housing HUD program. This is a case where, because it's a tax incentive program, there really isn't that belly button. So it leaves this, it really puts more onus on the locality and the state to find its way. What we're trying to help do is connect some of these good practices with each other to kind of get things together. So I think we're going to be moving now to the question and answer phase. And this very fortuitously, Jesse has helped cue us up with something in the chat with a question now, which is, what is the minimum amount of fundable projects to set up a community opportunity zone fund? In other words, do we need $10 million, a total value of projects, 50 million?
Right. So my view is there's almost no minimum. I mean, within reason, because you can keep funding the vehicle over 6 years. So if you said, look, our goal is $10 million, to have in a fund of equity capital, and we should be very specific. This is an equity incentive. So this is equity investments, people who want to own stock or LLC units. Banks can also be involved and give loans and get credit, but it's the equity program. But you don't have to raise all of it up front. You could say, okay, the goal is to do 10 million in this region of, a few zones that are put together, but we'll start with $1 million or $2 million. I think that there is an administrative level upon which below it's going to be pretty difficult, with the filings and the legal fees, but you don't have to have, the all or nothing at a very large number. But I would think that a community targeting at least a few $1 million to start would be a very good target.
Jesse, did that answer your question?
Yes, thank you very much.
Okay.
see another question in the chat, Steve.
Yeah, and please either raise your hand or those who are not here, put something in the chat. That's great. But our colleague from the Go Lab, do you want to raise your question?
Sure. I think Alfred mentioned that you could have a project that was a certain size, and as you expanded, that that grew the project, and that would be attractive to opportunity zone funds. We don't have that problem, but we did take on a opportunity zone investor. And when one of the questions that was put to our lawyers was, you know, as we expand and maybe build another facility in another state that was maybe not opportunity, or a location that was not opportunity zone qualified, there was some concern that that would run afoul of the program. Can you talk about, you know, the challenge of that? So, you know, if we're successful, then and we expand to other states, other areas, you know, we don't want to be tied to just necessarily opportunity zones if it doesn't match our business model.
Sure. No, that's a great question. And there are really two aspects of the program that help that problem be solved. Number one is the business or project itself doesn't have to have all its assets nor all its people in zones. You know, the shorthand is a 70-30 rule, where 70% of your assets have to be in a zone to be compliant. So you can have almost a third of your assets outside of zone, and how that gets valued is very, you know, it can be very technical, but there are ways for the business to expand out of zone and still be a compliant project for investors. So that's number one, and how that works and the timing of that gets pretty complicated, but something that gives you a lot of flexibility as a project. The other way to think about it, in addition, is that the investor, once you become non-compliant, let's say you want to sell the business and it moves, or you want to grow into a zone, grow into an area that's not a zone, the investor, when they get their money back in that exit, let's say, where you sold the company or moved it, has a year to find a new zone to invest in, for that investor still to have a good 10-year period. So there's a flexibility at the project level to go out of zone a bit, and there's a project, and there's a ability for the investor to basically have some of their investments outside of zone, about 10%, so just a little bit. But also, if you really do move out of zone, they get a year to reinvest that money. It's called recycling, and we help think through that also. So there's a lot of flexibility not to tie you into a zone if that's not really the right business case. Is that helpful?
It does. I guess my only additional follow-on question would be, you know, if the investor wants to stick it out with you and they haven't reached that 10-year timeline, and you say, for us, we build a second facility, roughly that would be 50% of our assets in a non-opportunity zone, 50% of our assets in an opportunity zone. What happens to the investor? What's the impact on that investment? The original.
Yeah, so that's why, you know, your investor, if that investor has 10 investments and you're one of the 10 and you become non-compliant, that's still okay. That investor, if all those investments were equal value, that investor is allowed to have 1 out of 10% outside of zone. So the issue is, what type of investor are you working with? Maybe a large investor who has a little bit of that flexibility. But if after 6 or 12 months of being non-compliant, that investor, unfortunately, will have a non-compliant asset. And what that means is that investor won't be able to keep going to year 10. So part of this, getting the right investor group, having them understand the risks of you maybe moving out, needs to be, you know, put on the table early on. But really what the IRS wanted is to say, look, get capital to these zones, give flexibility to these projects and companies to move out of zone if they must. Hopefully they move to a new zone, which is fine. But if they don't, then basically the investor has a year to figure out how to recycle that money.
I guess my own, I guess my only comment is, you know, this is more for the IRS, for anyone there, but we would be a potential success story in my mind, that, you know, we grow a facility in an opportunity zone, and then it expands and, raises an additional amount of capital in a non-opportunity zone, it meets the original objective because we haven't moved our facility out of an opportunity zone. We're just growing the business, and that sort of hamstrings that investment to be non-compliant, even though it really accomplished exactly what the IRS was trying to accomplish. Where, you start a business in an opportunity zone, and it's almost like penalizing the business for growing and handling their business plan the way that they should, which is taking each development stop as a a case-by-case basis.
You make a very good point, and I should also say that Senator Scott of South Carolina and Senator Booker of New Jersey, who were the two original sponsors of the law, they're considering, and I expect it will happen this year, a follow-on legislation called the Impact Law, IMPACT, which will basically, improve the zone law to really make sure it works, well, because it was put out there very quickly in the tax cut bill. Those types of comments should probably be filtered to the legislation. If there are ways to fix to make sure the intent is still met, that's kind of happening as we speak. Legislation is being proposed, and I would say the second thing is that there are ways to structure around it. You could set up two parallel companies, Zone Co and non-Zone Co, and have the new assets have a management contract. So we there are ways to address certain issues, but you understand what the intent is that money stay in zone. If you create a great company, hopefully it stays there for 10 years. If not, then there are ways to accommodate that.
Understood. Thanks. That's helpful.
Al, there's a question here from Tim Curtis. Tim, did you want to raise it?
Sure. Thank you. And thank you for putting this together this afternoon, Carlisle, and all your team. I don't always pay very close attention, and early on you made a comment or a reference to leveraging federal grant funds through opportunity zones or opportunity zone funds. And I'm aware certainly that when you apply for a federal grant, the fact that you are an opportunity zone kind of highlights you on that list of in peer review. So the town of Madison, in redeveloping the site in a partnership with a private company that happens to be GoLab, we have received about $1.8 million in federal funds through Northern Borders grants, CDBG funds from HUD, to work on redevelopment of that site to turn it into a forest products hub. What, if anything, should we be doing to connect those federal funds to the opportunity zone?
Sure, and I just will make the general caveat. I don't want to be giving specific tax advice, so everything is in general and without frankly knowing any specific situations. But I'll speak in general, and always please confer with your specific advisors for any specific tax advice. But to answer that question is that, again, the incentive ends up being the investor going to the IRS, hopefully in 10 years, and saying, I've made a profit, and that profit should be untaxed because look what I've done over the last 10 years. I've stayed in the investment, I used the proper gain. Anything else that investment attracts, bank debt that will get CRA credit, community reinvestment act credit, federal grants, that is all good. The IRS says this doesn't supplant anything else. This is an added incentive, frankly, that has, doesn't really even have to be disclosed under current law. The investor just goes to the IRS with their tax filing and say, I'm not paying tax. I normally would have, but I did a zone deal. So from the project's point of view, having grants and loans in the capital structure is very attractive, because if I were investing my $1 million as an investor and I knew that alongside of me there's $1 million grant that's also helping that investment succeed and be a good citizen for the community, that's really good for my investment. So I would say taking whatever you're doing now, advertising that to zone investors, saying, HAQUAF, remember the Qualified Opportunity Fund is the party you're negotiating with, as the investor, that investor fund. I now have added benefits from a federal program, from accelerated zoning approvals that still are within the law, from a bank loan that maybe is getting CRA credit and therefore has a lower interest rate. So I would say any other benefits your project or your area is receiving, I would almost make that a positive for the zone investors, because they're going to be beneficiaries of that directly or indirectly.
And I guess I might add here, from the federal government side, it is the fact that if they award this grant, it's going to be supportive of an opportunity zone investment, is again going to draw their interest. So for instance, if it's cleaning up a brownfield that would otherwise have been, a deterrent for the investor. But the feds know that in cleaning the brownfield, it will lead to a successful investment. All that starts to get some of the synergies. Do I have that right, Al?
You do. And remember, this is why it's so different from any other program you've seen. Usually the federal government gives a certificate. I used to run a small business investment company backed by the SBA, and you'd have to go through a process of, being certified and getting, access to the federal dollars. This is not that. I mean, an investor just does what he or she thinks is right, and then basically hopes and expects that what they did will get that benefit. So what the federal government has done, they're saying, look, we know this is happening. We passed the law. The zone, incentive is already put 15 billion in these funds. That could go to 100 billion, they expect. So we want to be part of that. We want to amplify the effect of this public-private partnership at the deal level with this money coming in. So you'll see what the prior administration did, and we are seeing the current administration is following on, is that they're trying to prioritize their dollars to tie to zone deals, because 1 + 1 is worth way more than 2, because now also all that money's creating winners. So you're going to see a lot more of what Secretary Buttigieg said, I believe, which is when we make our grants and loans out of our federal government normal flow, we want to tie to zone deals. So having a zone project or company is very attractive because they know that private capital is coming in.
Other questions? Al, you're incredibly erudite. You have.
I doubt that's the case,
this
Steve.
Very, very complex issue, some potentially complex issue, and made it understandable.
I guess I have another question. Could you speak on, you talked about Senator Booker and Senator Scott, maybe making some changes to the law that would make it, quote unquote, fix it. Could you talk about other potential changes that you've heard about? For Maine of particular interest, is there anything specific to rural communities, highlighting rural communities as a place to do investment? Because I feel like a lot of the communities on this call would probably say that of the opportunity zone investments that have gone on in the state, they, are marginally rural, if at all. As far as I don't know, a lot about what's gone on in the state, but as we keep our ear pretty close to the other rural communities, and so far as I know, GoLab is one of the few companies to receive an opportunity zone investment so far.
Sure. No, that's a great question. So about 2,000 of the zones, census tracts of the 8,700 are rural zones. So, almost a quarter are rural zones. And you're right, they often maybe haven't been, as much the center of attention. Sometimes maybe the word hasn't gone out to rural America. I spend a lot of time working on financing rural America personally in my prior career. So I'm a big fan of rural America. I believe when this new administration stands up, really the whole cabinet, that the USDA, that some of the other, the Energy Department, others will all have at least thought through, does my, set of added benefits, loans, grants, regulatory relief, and others, somehow tie to zones and how. And the prior administration had something called the White House Opportunity Council, where they tied all the federal agencies and departments that had an interest in zones. And there were, I think, 17 of them. How those programs tie to zones, that could be a vehicle, I'm not sure, of figuring out how then, Department of Education, USDA, DOD, they all basically are trying to help the communities during COVID, and it could be a great way to think about it. So I think we'll still have to wait at least a few more weeks or months to see how it in general happens. The second part of your question was what else could be in the draft legislation. Just last week, two congressmen, one from Texas, one from Tennessee, co-sponsored, because one is a Republican, one's a Democrat, drafted legislation to extend the period upon which zone investments can be made. Right now, new investments have to be made by the year 2026. So we still have almost 6 years to figure out, okay, where should investments be made? Because of COVID, because the rules were in draft form for 2 years, these two congressmen, and I know there's support in the Senate too, have suggested that the 2026 deadline be extended to 2028. So now that would give us more time to put money to work in these communities. And still, as we know, once you make those investments, you can hold them until the year 2047. So it's a long-term period in terms of how long you can hold that investment tax-free. But there could be tweaks like extending by 2 years the period. I've also heard that because many of the governors around the country are new governors, they didn't get to pick their zones. They've taken office since. Maybe they'll allow a few more zones to be added to the list, which maybe were missed in the first round that should be added this time. So we'll have to see what happens over the next few weeks. But I would say stay very close, because GRI and I are at CapZone, and my partners at CapZone are spending a lot of time making sure that the intent of the law is fulfilled, that capital really does go into communities that really, heretofore haven't received often their fair share. So we really want to direct as much supportive capital as we can to these communities.
So I just dropped into the chat box a link to the DOT announcement for the InfraGuard program. And again, I just think this is hopefully reflective of the trend. So this was just out last week on February 17th. But in addition to sort of highlighting, the department will consider whether projects located in a federally designated community development zone, including qualified opportunity zones. It also specifies that of the funding, and this is total of $889 million, 25% of the funding needs to go to rural projects. So I think that kind of formalization. And again, there's also an issue here about climate adaptation, and these are going to be the priorities. To the degree these projects are identified that can help support meeting social equity issues, they're rural based, they're supportive of sustainability and resilience goals, they're likely to be very strong candidates for federal funding.
And Steve, if I could just say one more thing, which is very important. Again, this law, no one really expected it. It happened very quickly. It's different in one respect that's very important. The IRS said this a few times in their final rules. Even if there's a loophole where an investor figures out how to invest, not in the spirit of the law, which, how do you find that? The tax incentive may not be given. So it really means the money really needs to go to these communities. It really has to be welcomed. It really has to be long-term, and no shenanigans. So I think it's really incumbent on all of us to say what should happen anyway. This is a unique moment in American history to guide this capital that has public and private aspects. It's like the muni bond market for equity. It's different, but let's make sure it works for the people. So I think that we should be thinking kind of large and programmatically, because the federal government now wants to put programs in place that have local support and private sector support. This program does that.
So Carla, I'm seeing we're at 1:02, and I think at 1 we were supposed to have done something next year. Robin, what's our next step?
Well, next is an opportunity we're going to go into breakout groups. Carlisle will do her magic. You don't have to do anything. You're going to show up at a group around each of the communities, and we have a person from CapZone in each of the 3 breakout groups. it's a few minutes for us to just talk at a community level. If you've got specific questions, or we're hoping this is helping make us think about what we can do in these individual locations. So we'll have an opportunity to talk there. And then in about 15 minutes, we'll come back and have a final little wrap up, and that'll be our meeting. So Carlisle, if you'll send us to our breakout groups.